Hi, and welcome back to our Mailbag series where we answer real questions from our audience. Hi, I'm Dave Lopez, founder and managing member of ILG Financial.
And I'm Chase Lopez, advisor with ILG Financial. And this is another episode of Retire Your Way with ILG Financial, where we talk all things retirement planning.
Okay, Chase, let me give you the next one.
Sure.
Right, this is from Bill. He's in Wisconsin, and he says, I've got an adult daughter. She's Chase's special needs.
Okay.
So right now she's okay living on her own, but he still helps her out. He
Sure.
helps her out financially, and I think he helps her out when he said we wrote it out, he helps her out with the bills and things like that. He's concerned that when he passes, she's not going to be able to, one, manage her finances because she's really not doing it now. He has a life insurance policy that'll help.
Okay.
And some assets that would transfer over, but he's not sure how this is going to work and if she's going to be okay. What would you recommend to Bill?
Yeah, so Bill, first of all, it's great that you're thinking about these things prior to, something happening to yourself. These type of plans want to be laid out well in advance of anything happening, right? Yeah. So first of all, I commend you for taking this into account. The first thing we would recommend for you is to get with either an attorney or some lawyer that is local to you and look into, now I'm not necessarily recommending that you need one, but you want to talk to them about what's called a special needs trust.
Yeah.
It's a specially designed trust for folks that have special needs heirs. And in that trust, it will lay out exactly who you appoint, right, to assist your daughter with finances and investments in the future. And it will lay out in plain English exactly how much will get paid to your daughter. And one of the things that I'm sure you're aware of is you want to make sure that whatever her income ends up being, she's still able to qualify for a lot of the healthcare stuff that she gets, right?
Medicaid,
things like that. There's certain thresholds that she can't breach. So you want to make sure, since it's inside of this special needs trust, that she's still able to qualify for all of those things. So first step is get with a local attorney, right? Get with your financial advisor. Make sure that they're working together to build out a plan so that all of these things that you want addressed are addressed. Because the simple fact is they can be, right? This is not an uncommon situation. And folks every day build out plans to make sure that their special needs heirs are taken care of.
Yeah, it addresses all of them. You can address who's investing the money and how much risk, so your daughter never has to do that.
Right.
You're shielding this money from the Medicare spend down,
right?
So she can still get Medicaid and Medicare,
right?
Protects the assets and has someone really looking over the disbursement of the money.
That's
so
right.
She doesn't have control of it.
That's right, because Bill, you're not going to be there. You want to make sure that you enlist someone else to be there, for your daughter. But great question. Thank you for that.
Yeah, good answer. I like that.
All right, Dave, next one is for you.
Okay.
This is from Steve. He's emailing in from San Francisco.
Okay.
And his question is, he has some stocks that he bought, and they've gone up 10 times since when he bought them. So his question is, he wants to move away from having all of his money tied up in these stocks, and he wants to sell them. What would be your advice there?
Yeah, so that's a good question. And this comes up a lot, right? It's what we call the tax dilemma, right? You get this tax break. It's called unrealized capital gains. As a stock, it's the same for real estate, right? As it raises in value, the way our tax code's written, for those of you who aren't Steve, right? If your stock goes up in value, you don't pay tax on that increase until you sell it, until it's realized. That's why they call it unrealized capital gains. So Steve, if you sell that stock, you're going to have to pay the tax. There's no way out of that. Now, the good news is under the current tax code, you're going to pay less tax than you pay on your Social Security or your pension or your income. That's called ordinary income tax. Your capital gains tax is lower. It's usually anywhere from 0 to 15 to 20% for most folks.
Right.
As opposed to it could be much higher in your ordinary income tax.
Makes sense.
So you can save a little money in theory. Usually if you have a state tax, not estate, a state tax like Virginia, for example, they're still going to tax it the way you tax your ordinary income. So you can't avoid the tax by selling.
Right.
I would suggest, Steve, the bigger question is you want to pinpoint what's the goal of this bucket of money.
Sure.
One way under current tax code you could avoid this tax forever is to never sell it. Then you die and your child or your heir inherits the money. under current tax law, they get what's called a step up in value, which means if you sold the stock a day before you died, you'd pay tax on it.
Right.
Then you die, the next day later, your heir sells the stock, they pay no tax on it. It's a great legacy transfer, tax efficient legacy transfer. But the plan there would be you would decide, I like this stock, I'm never selling it, no matter how high or how low it gets. If you're planning to use the money, that's when you want to get with an advisory firm and build out a specific plan to sell this money over time in a tax efficient manner.
Right.
And it has to do with how much of the money do you want to sell.
Right.
We also want to take into consideration, aside from the taxes, the risk side. Are you selling because you just don't want so much exposure to this company?
Right.
We used to do a whole training where we talked about this idea of I don't want to sell because I don't want to pay the taxes. Well, other than what I just explained about the legacy, if you're going to eventually sell it, well, if you're expecting taxes to go up in the future, your tax hit's going to be, you're better selling it now at lower taxes than you are later at higher taxes.
Right.
The other thing is the only way to avoid the taxes, if the plan would be, if you play that scenario out, would be you wait for the market to crash. We have another 2008 crash, and then you say, what, good luck, my account dropped back down to the price where I bought it.
Right.
I can now get out and pay no taxes. No taxes,
Didn't
but
make
no
any
gains.
money. Right.
So focus on the idea that if we're getting out for investment reasons,
Right.
then net of the taxes, we've got gain.
Right.
Right?
Right.
To avoid the taxes, you either have to give the money away or wait till the stock tanks. But you could consider holding it if you like the company, you want to hold it very long term, and you've earmarked this bucket of your retirement for your legacy play to your heirs.
Yeah, that's a great point, Dave. I think a lot of people get caught up in the minutia of the tax situation when the whole goal of the market is to buy low and to sell high. Sounds like, Steve, you've done great. Your stocks have gone up 10 times, right? So definitely something to consider.
Yeah, if you want to use the money, you got to pay the piper.
That's right. That's right.
All right, Chase, ready for another?
Absolutely.
This one's from Charlie, and Charlie says, my wife, we're entering retirement, and she wants to take several trips, a couple a year.
Sure.
Right? How much should I allot to travel? We call it travel fund money.
Sure.
In addition to our normal budget, where we're not allocating that money now while we're working.
So, as like a lot of answers for our mailbag here, it's largely dependent on your specific situation, right? So my first inkling is to say, get with your financial advisor and get with them in plain English or in real numbers, be able to quantify exactly how much these trips are going to cost. A trip to Europe or a trip to Myrtle Beach, those are very different costs, aren't they? So you want to make sure what are the costs for these trips. Now, with respect to how much you should spend, that's tied directly to how much income you have coming in, how much you have saved. So that's something that you want to plan out in advance with your financial advisor. A great thing that we talk about is any money that we have saved that you plan on using for, fund money or really anything in general.
Anything, yeah.
You want to make sure that you're comfortable with the amount of risk that specific bucket has, right? So if you look in the description below, we've done previous videos and podcasts about sequence of return risk, and this ties directly into you taking money out for these travel plans. So it's largely dependent on your current situation with income and assets. One tip that I can give you is, since you're in retirement, a lot of times there's discounts for different vacations and things of that nature, maybe cruises if you're into that sort of thing, for folks that are in retirement. So just be on the hunt for some of those deals that they have out there that are geared specifically towards retirees.
Yeah, that's a good answer. Right? Know your numbers.
That's
I think
right.
would be the takeaway.
That's right. All right, Dave, got another one here for you. This is from Greg in Wichita, and Greg said he has the option for a lump sum pension and a monthly payout.
Got it.
He's asked about 10 different coworkers, and he's said it's split even. Some say take the lump sum, some say take the pension. So he's wondering what he should do.
Yeah, just to make a point, I saw why you're laughing, is that we get this question a lot.
Yeah.
And it's always the same thing. As I ask coworkers, and we're like, are they in the pension business?
Yeah.
And they go, no, they're in the business that you're in.
Yeah.
Right.
Yeah, right.
So it's not surprising that you get frustrating answers, right? That's not their area of expertise.
Right.
It is our area of expertise, right? So what you want to do is you want to get with a financial professional who focuses specifically on retirement planning,
right,
and ask them to run a pension optimization analysis for you. We do it all the time. It is just the numbers. It is that simple. It's the math. What we will do with that is we will take a look at the lump sum, and we will take a look at the monthly if you take the monthly.
Right.
And then we can actually figure out what break even is. Right. If you were taking money out of the lump sum and earning a reasonable rate of return that you want to use in the analysis.
Right.
And then it'll be very clear which is the best way.
Right.
But the other thing to consider is, do you need the pension?
Right.
Right. If you've got 2 or 3 other pensions between you and your spouse and Social Security checks, if you don't need this pension, then usually, not always, we would recommend taking the lump sum.
Right.
Why? Because you can take the lump sum inside an IRA, avoid the tax,
right,
and now take the money out on your terms when you need it for fun or travel, or never if you want it to be legacy.
Right.
Right? As opposed to the pension, you're just getting a taxable check every month that you then have to pay tax on and reinvest.
Right.
Very tax inefficient.
Right.
So pension optimization analysis, get with a financial advisor. They want to run the numbers of all the scenarios. You can even compare them to life expectancy and things like that.
Yeah.
And see what's the best fit for you.
Yeah, that's a great answer, Dave. Get with your financial professional to see, what your best fit is for you.
Yeah, and if you don't have a financial advisor, or you've got one that doesn't know what a pension optimization is, no worries. Just find one who does, because anyone who focuses like we do on retirement planning will or should be very well versed on how to do a pension optimization analysis.
Absolutely.
Okay, Chase, you ready for one more?
Yep. Absolutely.
Okay, this one's from Carol. And Carol's question is, this is a great one that she's on top of this. She says, I have a lot of life changes coming up in the next 6 to 8 months.
Sure.
And her question is, should I just leave everything invested as it is, or should I be moving some to safety? I think that she used the word cash.
Right.
To cash until the dust clears and I understand what's going on.
Sure. And Carol, we get this question pretty often, right? Yep. Being, financial planners and being in the space for retirees, there's a lot of different things that can come your way as you kind of approach retirement and get into retirement. So you're thinking about all the right things. The first question that I would volley back to you is, okay, these life changes that we have coming, what are they, right? And are they going to cost anything monetarily, right? Whether that be, for some people, it's I'm going to retire, right? I'll lose my paycheck. For others, it's I'm going to pay for a wedding, or I have an unexpected grandchild on the way.
Need a new car.
Need a new car, right? First, you want to figure out and quantify exactly how much those are going to cost. And if you're going to need them in the short term, if you're going to need these funds for these changes in the short term, then by definition, they should not be invested in something that's volatile, right? And the stock market is a great example of that. So,
and let me interrupt, because this would be a question I would have. Where you threw out the word short term.
Sure.
What does that mean?
Well, funny you asked that, Dave. Warren Buffett has a saying that he basically says, if you're not willing to be in the market for 10 years, then you shouldn't be in the market for 10 minutes. So if Warren Buffett says 10 years, I would say use that as a litmus test, right?
Yeah, so that's the market, right? But if we talk short term, there's still other investments. It's not cash for anything under 10 years.
Sure.
Right? There's more conservative, depending on if you need it in 5 years, 36 months.
That's exactly right. That's exactly right. So you want to be crystal clear with whoever's helping you out with your financial plan.
That's a good point. Yeah.
When you're going to need the money, to your point, Dave, and how much of the money you're going to need. So to your point, if I'm going to need it in the next 6 to 12 months, then we probably should have it, readily available. Cash is the liquid investment, right? But it needs to be readily available and safe so that we can pay for that expense that comes up, in the short term.
If you needed it in 2 years, right, you would be a little different.
Right. Exactly. That's exactly right. That's exactly right. And there's a whole host of different investments that can achieve these different time limits.
Or combinations of them.
That's exactly right. So again, get with your financial professional and you want to implore on them, hey, I want to make sure that this money is available for me to use in 2 years, 6 months, whatever your situation needs. Yeah.
I think we covered them.
Yeah, so join us again for another one of our videos in the future. Hit the like and subscribe button and you'll get alerted for any of these future videos.
See you next time.